Our next guest is seeing opportunity in the oil and gas industry as multiple contractions across the sector coupled with investor fear have driven stock prices lower. Joining us for today's Trade Talk is James Telfer, Associate Portfolio Manager at Caldwell Investment Management. James, thank you so much for joining us today.
My pleasure.
And let's start with your base case scenario here in terms of where you see the prices going, because I'd like your take on this, but where can these stocks go if the commodity prices continue to move lower?
Yeah, well, we're looking at two things. We've been following a lot of the oil and gas service companies, which one of them I'll talk about after. But if you're talking about the E&P type companies, you know, there's still a lot of risks there, but we're starting to feel that maybe the downside is getting more limited than the upside. It's not something that you want to go all in on at this point. Who knows where natural gas prices are going to go or oil prices. But when you look at some of the valuations and you focus on the companies that have very strong balance sheets, or even companies that are shifting from natural gas to oil and can sustain that growth, we think there's some opportunities there.
So from that perspective, let's talk about some of the opportunities, because
Sure.
This is a difficult call to make, really, because we continue to see some of these oil prices, nat gas prices move lower.
Well, one of the companies that I brought with me tonight, it's one that is exposed to the oil and gas sector, but not a lot. It's actually 55% of their business comes from the oil and gas sector, and it's Badger Daylighting. The ticker of that's BAD, and it's a company that has these really cool trucks that actually help build pipelines and infrastructure in the space. So they have a lot of exposure to the oil sands, which is an area that we like. But the other 45% of their business is related to the utility space. So you get that exposure to the oil and gas, the growth that's happening there in the oil sands area, but you get the safety of the utilities.
The stability of the utility. So what kind of growth and earnings do you expect going forward?
So we expect, this is a company that's been consistently growing. So it's trading at very reasonable multiples for the level of growth that they've had, but they don't just go out there and build and manufacture a number of these trucks. They build about 2 per week, and with the revenue per truck they're getting right now about $32,000, they can get an IRR, rate of return on that, in somewhere between 14 and 20%. So they're just a nice, slow growing company, and they pay a 4% yield as well.
Oh, that's nice. To what extent are they exposed to natural gas? With natural gas trading the way it does, I've been hearing all kinds of conversations as to plant shutdowns, actually, that it becomes no longer profitable to keep it open. Are some of these, is Badger going to be affected by anything like that?
Not so much, which is why we like it. It's more exposed to the oil sands area,
right, okay.
But also the infrastructure projects. So you're hearing a lot of talk about pipelines, building pipelines out to the West Coast, building pipelines down to the U.S. So that's the stuff that will benefit a company like Badger.
What else do you like, James?
Well, we're looking at another company in the electronic space, which is Celestica. So it's a company that's well known in Canada, and it's recently, I had a great report in January, and it ran up to about $10, and it kind of caught our list, because we look for companies that have good value but also have good momentum, and so it caught our eye, and then it got away from us. But recently it traded back down into the $8 range, so we started dipping our toe on this position. We like the company. It's shifting a lot away from the consumer electronics market into more diversified businesses. So stuff like healthcare, aerospace, stuff that actually there's more growth down the road.
I know the balance sheet's bulletproof.
Yeah, there's no debt.
50% of the company's revenues are in segments that are shrinking.
Yes, so that's something that you definitely have to look for. So, the big conversation that you have when you talk about Celestica is obviously research in motion. What's going to happen if research in motion? I did the math on that before we took on this position, and it doesn't actually affect the earnings that much, even if that whole business line came out, because they don't get big margins on these shrinking businesses. They get about 2 to 3% margin on some of this stuff. So maybe on the revenue scale it's a big hit, but on the actual bottom line earnings, the risk isn't as great. So just to give you an idea of the valuation, if you take the cash out of their multiple, they're trading at about 4 times, and that's compared to net cash PE multiples of their peers at about 7 or 8 times.
But what's the catalyst to get this stock going higher? Because one of the issues with some of these companies is the customer concentration. What's that like for Celestica?
It's definitely concentrated. So they've got about 10 main customers that are concentrated. So the catalysts are going to be bringing on new customers, bringing on new lines, getting more and more into the diversified space. So to give you an example, the growth is about 50% in the diversified space in the last year. So they have been growing that area. So that's a very positive catalyst that we see. They've also been doing buybacks. So some investors may have wanted a dividend, but a 10% buyback is pretty good, and it should grow their earnings.
Earnings have been very volatile. Celestica has been a very volatile stock to trade. What was the reason for the recent softness?
The recent softness, I think, came from a report, a sell-side report that came out that maybe pushed the stock around. But it is a volatile trade as well. I mean, it's sort of leveraged to the technology space. It's a higher beta play on that. So if you think that consumer confidence and spending is going to increase, that should tie in nicely to a company like Celestica, who benefit from the end products increasing their manufacturing.
Right, and so your preference of Celestica over, say, a Flextronics or a Jabil Networks, again, why those? Just strictly valuation?
Yeah. So
what about end markets?
We looked somewhat at the end markets, but the fund that I look after is a Canadian fund, so that's why it got onto our radar. But it is extremely cheap, and so we definitely look at the valuations relative to its history and relative to its peers, and for that reason, we just
well, it's certainly cheap compared to history, that's for sure, 10 years ago.
Yeah, absolutely.
All right, and James, speaking of your fund, you guys are actually up 9% year to date. What do you think really drove that performance?
Well, it's the unique style that we have. So we have a 50% blend on value and momentum. So we're buying companies that are increasing in estimates, increasing in earnings, increasing in price, but also companies that are showing extremely good value. And then when you couple that with good fundamental analysis to make sure that the bottom's not going to fall out on a company, it works really well. The other thing is that we're concentrated. So that's one of our key themes. So we hold about 18 positions right now. So we make sure that the companies that we're buying fit that build very well, and we benefit from that.
Okay. I guess you did very well since inception, because you say that you're small cap, mid cap, and that has been a tough segment in the market in the last quarter.
So we've built in a number of parameters to ensure that we have pretty good downside protection. All the testing that we did made sure that we had that there. So we held up well through from August to December, and then when we got an upward channel market, we really benefited from that.
Are you purely long, or is it long short, or is there any hedging going on?
It's a long-only fund, long-only Canadian equity fund.
Very good.
Yeah.
Congratulations.
Thank you. Thank you.
Tough environment.
Yes.
Great to have you here. Thank you for
My
joining
pleasure.
us. James Telfer, Associate Portfolio Manager at Caldwell Investment Management. And up next, have capital markets become too dependent on central bank easing? We'll look into that ahead of the curve next.